This is Money in Motion, your passport to the global currency markets. I'm Melissa Lee. Here's where the money's moving tonight. Back up the buck, the dollar demise continues. But we've got the man from Merrill who says now is the time to buy the greenback. We'll tell you if you should too. Plus, cold cash, hot commodities. The rally in gold and silver continues. But we'll show you how to get long for just pennies on the dollar using currencies. And can you see the profit in this pattern? We can, and we'll explain at the Money Map. Money in Motion starts now. It's a $4 trillion market, and we're going to teach you how to trade it right now. So let's get to the money matchup. And stop me if you've heard this before. But the dollar swoon against the euro reaching epic proportions. And now the big question for traders is, when is 150 coming? Is that a foregone conclusion, Andy?
Well, I mean, we're not far away from it, right?
Yeah.
I mean, we're pretty much there. But, yeah, it's going to be kind of a fun number to hit. And it'll be printed out all over the place. And you'll hear it in the media. You'll hear it here. Of course, we've been talking about it for a long time, so I feel pretty good about that. This week, Ben Bernanke kind of supported that by saying QE2 is going to stay on. Really, the structures we go over all the time on this show are still in place. That's why the dollar continues to get shellacked.
Right, and those structures are low for long U.S. rates versus the rest of the world and good risk appetite. The stock market's doing really well. Americans have the risk appetite to put money overseas, sell the dollar, buying everything else.
So it's an orderly decline in the dollar. And also, we can't forget Mr. Ben Bernanke coming out this week, holding his first ever press conference at the Federal Reserve. And basically, you know, QE2, the end of it was a foregone conclusion. The question, though, is tightening. When will that start? Because just because QE2 ends doesn't mean tightening is going to begin anytime soon. And that's going to probably be, I would imagine, Andy, when traders think the dollar will actually start to appreciate.
Yeah, and that's precisely the point. As far as interest rates go, we actually had interest rates came down. I mean, the short-term rates came down. We took out of the market some of the belief that the Fed was going to start tightening somewhere in January, February. I think it's passed out beyond February now. That just sits diametrically opposed to what the ECB did just like a week ago, where they raised rates. So that's the key. They're not going to stop easing. They're going to keep an easy monetary policy. Tightening is down the road. So they may end the super quantitative easing, but the structure there, still weak dollar.
And I think it's interesting, too, in this week ahead, we've got another ECB meeting, and we're not looking for another rate hike. The last one was in early April, but we do think that Mr. Trichet is going to continue to be hawkish and set the stage for another rate hike. So, again, just highlighting that divergence between the U.S. and Europe.
All right, I'm actually very excited about our next guest. I'm excited about all of our guests, but this one in particular making a bold call on the U.S. dollar. You want to listen to him as he's Bank of America Merrill Lynch's head of global rates and currencies. David Wu is taking the other side of a very crowded trade here, saying buy the buck now. Welcome to you, David. And the big thing is, David, we touch upon this here on the desk, is the tightening cycle isn't going to start anytime in the foreseeable future. Why would you say to buy the dollar now?
I think, I think a lot of people don't understand exactly how QE2 actually works. And I believe that actually the end of QE2 in itself actually is going to be positive for the U.S. dollar. Think about it this way. The Fed is currently buying about $75 billion of treasuries every single month. When the Fed ends, this money will have to come from somewhere else. One place that this money can come from is the stock market. If that comes from the stock market, we're talking about lower stock prices. There's nothing the dollar likes more than falling stock prices. The other place where the money can come from is basically abroad. If foreign investors end up buying more treasuries, and they could buy as much as $50 billion of more treasuries every single month, that means that they have to buy $50 billion more dollars every month. That will be good for the dollar. So the point you have to ask yourself, the question is, if the Fed is not buying, who else is going to buy? And anybody who's going to be buying treasuries, you know what? Guess what? That's going to be good for the dollar.
So, David, two things that come to mind. One, 2002 to 2007, we didn't have QE1, we didn't have QE2. Foreigners were buying the treasuries, and the dollar still went down. So I'd love to hear your sense of that. But the second thing is, do you think this is partly a positioning story for you? Getting from 148 to 130, do you think some of the juice for that, so to speak, is going to come from the fact that everybody's so short dollars now?
Sure. I mean, I think, there's no doubt. Obviously, foreigners have been buying a lot of treasuries over the years. But remember, in the last 6 months, for example, the tick data showed us very clearly the Chinese have not bought a single treasury bond. Definitely the foreign official sector has been pulling away because they don't find treasuries very attractive at this level, given QE2 has been depressing the risk premium treasuries. So I think from that point of view, what I'm talking about is an increase of foreign purchases that will basically be supportive for the dollar.
All right, David, we got to leave it there. Thanks so much for coming by. We do appreciate your time. David Wu, Bank of America, Merrill Lynch. Andy, I saw you, I don't want to say rolling your eyes because that would be disrespectful to David, but skeptical of what he had to say.
130 is a big move.
That's a big move. 18 big figures in our terms is huge. And I think the time frames are real short, too. So, you know, the thing is I do buy what he said. He was quoted in a Wall Street Journal article by Andrew Johnson. He said the bar is set very low for a dollar rally here.
Right.
And everybody's crowded into this. And that's exactly flows really nicely into the trade that
Let's get to it, Andy.
All right, so here's what we're doing. We are going to buy the euro, but we're not going to buy it here. We're actually going to wait for it to pull back to where it had some resistance going through before, and that's at about 140. What do I get? This 146.50. With a stop loss just at 144.90, so very tight stop. And then we're going to try to take profit on this thing above 151.25. 151.5 was a recent high, I think it was about 2 years ago, to be honest, for the euro. So we're trying to play this. I think that we've seen this, just the momentum has really been just stretched so much on this. I'm looking for about a 200-point pullback from these levels.
And I think you could get that dollar rally, that pullback in the euro if we got a good non-farm payroll this week. Remember, we've got that coming up this Friday. 183,000 is the consensus forecast.
Right.
Or if Trichet disappoints.
You know what? That's what I was going to say. You know, Trichet, typically after an ECB meeting, when they've been hawkish and they raised rates, the next meeting they kind of back the language down a little bit to kind of tamp down expectations. I think that might happen next week.
So buy the euro on a dip.
All right. So bottom line here, Andy does see some more pain for the U.S. dollar. He's getting long euro at 146.50. And if you're not doing anything Sunday at 5 o'clock, that is when you can put this trade on. That's because the currency markets do reopen for trade then. All right, let's move on here. Time for cold cash, hot commodities, where we show you how to use currencies to trade commodities. The dollar pain has been gold and silver's gain, as you know. Those metals continuing to defy gravity. Crude also closing in on record levels. Will this rally continue? Peter Schiff is the CEO of Euro Pacific Capital, the author of How an Economy Grows and Why It Crashes. He can be a little shy, sarcasm here, about his opinion, so we're going to try to pull him out of his shell. Peter, it's always nice to see you.
Nice to be here again.
All right, I asked you this the last time you were on this show, Peter. I know that you're bullish gold, you're bullish silver. Give us a time frame in the forecast here.
Well, I mean, maybe if Ben Bernanke gets sick or something and stops talking, maybe the metals will take a breather. But as long as he's out there scaring everybody, saying there's no inflation, you know, it reminds me of E.F. Hutton. You know, when Ben Bernanke talks, the gold traders listen, and it's music to their ears if they're a bull. And they're just going to keep on buying. And, you know, the dollar index hitting a new, I think, about 3-year low. Imagine where the dollar index would be today if the Deutschmark were there instead of the euro.
Peter, let me ask you this, though. Let's say the emerging markets get a little more serious, start raising rates to deal with that inflation. Would that change your outlook for gold at all?
No, not at all. I mean, first of all, I don't see any of these foreign central banks getting aggressive enough to damage gold. But as foreign central banks raise rates, that is going to make their currencies far more appealing than the dollar, and so that'll accelerate the downward pressure on the dollar, which of course is good for gold, particularly from the perspective of a U.S. dollar investor.
So what would be the risk to your view? We know your view, but what would make you change your mind? What's something you'd be looking at?
Short of Ben Bernanke's stopping talking, et cetera, et cetera.
Well, look,
duct tape.
There can always be a correction in a bull market. I mean, so you can have a correction at any time. But the only thing that would really make me change my mind would be, you know, fiscal responsibility in Washington and sound money at the Fed. But neither of those things is a reality. The only thing that can hurt gold is not going to happen because the politicians don't have the guts to prick this phony bubble economy. So they're going to keep blowing air into it in the form of cheap money and low rates. And that means gold's going to go up, silver's going to go up, commodities are going to go up, everything is going to go up. Stocks will go up too, but they won't go up as fast.
All right, Peter, we're going to leave it there. Thanks so much for your time. Peter Schiff of Euro Pacific Capital. And, of course, we're talking gold and silver. We got to get the technical levels on these metals. So we go to Todd Gordon, who is standing by, as usual, at the Money Map. Hey, Todd.
Hey, guys. You know, I agree with what Peter's saying. As far as an upward forecast of 5,000, I'm not so sure. But taking it down to a trading time frame, I think it's important to look at the gold market, but also look at silver. For a currency trader's perspective, it's important to watch the interaction between the two. And there's something that's interesting that's going on here. Take a look at the gold in the white bars in the background. We had a move in the last 2 hours in New York trading today. gold went parabolic. So right now, the path of least resistance for gold is higher. But what's interesting is look at silver in teal. Silver is not confirming what the gold market is telling us. So gold is pushing higher, silver's not confirming. That tells me that the markets are not as encouraged from a risk-on perspective. Typically, in a higher stock market, higher risk-on perspective, you want to see silver outperforming gold. The opposite's happening. So as that pertains to the U.S. dollar, we're not so sure, but just be careful from a risk-on perspective. That's very telling.
All right, so if you're concerned about the risk-on aspect of the trade, Rebecca, that may be the perfect reason why you might want to use currencies as opposed to the commodities themselves to actually play this.
No, absolutely. One nice thing about commodity currencies is that they're much, much more liquid than the commodities themselves and less volatile. So we've seen some crazy moves in silver and to a degree in gold in recent weeks. You're going to have less volatility in the currencies, and that might be a good thing if you like sleeping at night, which I do. So should I tell you about the currency I like right now?
Yes, you do.
Okay,
Yeah.
so I wanted to focus our attention this week on the Canadian dollar. There's a couple things that drive the Canadian dollar. Oil prices. Here's our commodity tie. Canada exports a lot of commodities, but energy is the biggie. Interest rates. So right now, rates in Canada are 1%. We think the next move is coming in July, so rates are going up, supportive. And then finally, risk appetite. And that would be the caution element here. To the degree Todd's right, and gold and silver are giving us a pause button, we need to take that into consideration. But as long as equity markets hold up, risk holds up, I think the Canadian dollar can keep strengthening.
The only thing, I've got to throw a caveat out there. First of all, because the Blackhawks lost to Vancouver, so I have to talk against Canada.
I don't know what
just
that
on that.
means.
Yeah, it's hockey, so that's okay. The second thing is that Carney came out and said that they don't want to see expanding interest rate differentials. And I think that's one of the reasons why the Canadian dollar has been slow, not like the Aussie dollar, which went ballistic today and the next couple of days, but that's why I think Canada's a foot dragger here, and you may get your opportunity to get in at a cheaper level. So that kind of worked with your trade.
Let's see what Rebecca's trade specifics are.
Sure. So we have an election in Canada on Monday, and I think it's probably going to be a non-event. But if we got a pullback in the Canadian dollar on some temporary uncertainty, great, wonderful. We have a better entry level. But let's talk about what the trade is we could do right now. So dollar Canada broke through 0.95 today. We got just below that level. I think that's important. It's a big psychological level. It's opening us up to more Canada dollar strength. We're going to target a move down to 92. That's 0.92. I'm going to have a stop loss around 0.9640. And so I'm going to, if there's some temporary weakness in the Canadian dollar, great, because the story's intact. Rising rates, commodity exports, and I think bigger picture risk appetite.
Yeah, and I like that. I mean, I like looking for a dollar strengthening a little bit, small period. We always try to do something a little bit cheaper when we get in these trades, and that works. I think you stick with the trend. That's what that trade is.
All right. The bottom line here is Rebecca likes the Canadian dollar against the U.S. dollar for catch-up play on the commodity rally. And if you're not watching the NBA playoffs at Sunday at 5 p.m., which I know Rebecca's going to be doing.
Of course.
or even if you are, you can start trading currencies at Sunday at 5 p.m. Eastern Time.